All right, let's talk Rocky Mountain Chocolate Factory, ticker RMCF. They just dropped their latest earnings, and honestly, it's a bit of a head scratcher. They're trying something really bold, a total pivot in their strategy. And the results? Well, they're kind of all over the place. So let's dive in and make sense of it. Okay, so check this out. This is the whole puzzle right here. On one hand, their revenue, it's down more than 5%. Not great, right? But then you look at their EBITDA, and whoa, it swung positive by $800,000 year over year. So what gives? How on earth do you sell less stuff but somehow become way more profitable? That is the big question we're going to answer today. So first things first, let's get into the numbers, the earnings snapshot. This is where you start to see the method behind the madness. Okay, so looking at the table, you can really see the trade-off they're making. Yeah, revenue's down, we see that, 7.5 million, but just follow the numbers down. Gross profit, it doubled to 1.4 million. And their manufacturing gross margin, that jumped almost 9%. And then you've got that huge $800,000 positive swing in EBITDA we were just talking about. This wasn't some happy accident, folks. This was 100% by design. So how'd they pull this off? Well, it all boils down to one thing, their margin-first plan. And you really got to understand this to get what's happening at RMCF. And here's the core idea. RMCF is basically saying we're done chasing bad sales. They are deliberately walking away from business, specifically the low-margin stuff that was just weighing them down. Think of it like pruning a plant, right? You cut back the weak branches so the whole thing can grow back stronger. They're taking a short-term hit on revenue to build a much, much healthier business for the future. It's addition by subtraction. And management's got a really clear playbook for this. It's a simple 3-step process. Step 1, stop the bleeding. Get rid of the bad revenue. Step 2, fix what's left. Make the core business as profitable as possible. And then, and only then, step 3, grow again. But this time do it the right way, with a solid franchise model. It's a classic turnaround strategy, laid out perfectly. And listen, this isn't just a bunch of fancy slides in a presentation. They are deep in the trenches, making this happen. They've already gotten rid of hundreds of products that weren't selling well. They're tweaking prices, cutting back on overtime, all that nitty-gritty stuff. Plus, they're rolling out a new point-of-sale system to over 120 stores. And that's huge because it's going to give them way better data to see what's actually working. This is the hard work that really makes a difference on the bottom line. So now that they're shoring up the core business, they're starting to hit the gas on step 3, growth. And check this out. This is the big one. They've signed deals to open 34 new stores. 34. And this isn't just random growth. They're teaming up with serious partners. Operators with deep pockets who know how to scale a business. This is the future. This is the pipeline that's supposed to get that revenue chart pointing up again. Okay, so management has a plan, and they're hitting their numbers on the profit side. Sounds pretty good, right? But what did the market think? How did Wall Street react when they heard all this? Let's take a look. Well, the stock chart tells a fascinating story. At first, it looked like investors were buying it. The stock opened down slightly, but the story was good. They clearly liked the news about better margins. But that feeling didn't last. Through the day, it just fizzled out, and the stock ended up closing down 7%. It's a classic pop and drop, and it tells you one thing. The market is skeptical. And this really gets to the heart of it. The market is basically saying, okay, great job on the margins, but show me the growth. Look, making more money on less revenue is a good first step, but it's not the whole story. Investors are on the sidelines, waiting. They're not going to pile in until RMCF proves it can stop the revenue slide and start growing again, but this time profitably. They want to see both sales and profits going up.
So with the market waiting for proof, what should we be watching for? Let's break down the bull and bear case, what could go right and what could go wrong.
The bull case is pretty simple, right? The story works if these margin gains stick around, the revenue finally bottoms out, and those 34 new stores actually start opening and bringing in cash. That's the dream scenario. But the bear case is all about risk. First, can they actually pull all this off? It's a lot to juggle. Second, what about cocoa prices? They've been all over the place. If they spike, that could kill their margins. And finally, what about us, the customers? In a tough economy, are people still going to be willing to spend on premium chocolate? A lot of question marks there. All right, we've laid it all out. The plan, the numbers, the market's reaction. So let's put it all together and make the call. Here's our rating. So what's the final verdict on RMCF? You have a management team that's doing exactly what they said they would do on profits, but you also have a market that's clearly saying, not so fast. So what's the call? We're rating this one market perform. And here's why. You absolutely have to give them credit for the huge improvements in profitability. That's real, and it's impressive. But the risks are just as real. They still have to prove they can execute. That top line is still going in the wrong direction. And as we saw, investors are demanding proof. So for now, we think the stock is probably going to tread water, basically perform in line with the overall market, until we see two things: stable revenue and proof that those new stores are actually opening their doors.
And as always, remember, this is not financial advice.